So on today's episode of How Not to Raise Capital, I'm going to go over a recent case that was filed dealing with the SEC and a capital raise and what they alleged was done wrong. And again, this was just recently filed, so no one has been convicted or had any judgments rendered against them. So these are all allegations, but it is something to look at to kind of get an idea of what to watch out for or pitfalls when you're raising capital. So I'm going to share my screen real quick. And okay, so how not to raise capital. And the case we're going to look at is SEC versus Barton. So what are some of the legal issues in raising capital? Just briefly go over these since I have other videos that go over them in more detail. Securities Act of 1933, dealing with registration or exemption of securities. Exchange Act, Section 10B and 17, dealing with misleading or defrauding investors. Section 15 of the Exchange Act, dealing with registration of brokers and payment of commissions. Investment Advisors Act and Investment Company Act can come up. That's more common in dealing with a fund when you have a group of people investing in multiple companies. And in general, corporate tax and state law compliance issues. So generally what we've seen is I would categorize in kind of four main areas for key issues. Disclosure and compliance is the biggest one. Making sure you disclose everything to make sure it's not false or misleading in your offering materials, your PPM, webinar, any of that. And also avoiding clients will often try to avoid something being considered a securities offering by saying this is just a partnership or this is a joint venture, or it's a note, a loan. It's not really a security. It is. I can almost guarantee 99.9% of the time, the SEC would consider that a security because the definition is so broad. So, and it's easy to comply with exemptions. So just go ahead and do it. Also brokers, whether you're a registered broker, an exemption to be able to get paid a commission or finder's fee, that's a huge issue that can come up too. So fees is the second category, making sure you disclose every type of fee and compensation being paid to people associated with the capital raise. The main issue is unregistered brokers who are paid fees, like a success fee or commission, based on a percentage of capital they raise. That's a big potential issue. Also, you want to make sure you've disclosed any of these kind of fees. Execution is basically if your business plan, PPM, says, here's what we're planning on doing, Mr. or Mrs. Investor, and you don't do that, then that can be an issue. So you need to execute on your business plan. Doesn't mean you can't change it, but usually you should update your investors if there's major changes, like you're buying a property in Florida, and then all of a sudden, well, that didn't work out. Now we're buying a totally different type of property in New Jersey. That's something you should probably notify your investors that your business plan has changed. Normally you want to try to, if you've promised you're going to do something, you want to try to fulfill it. Misappropriation of funds, another huge area. Using investor funds not the way you said you were going to, whether it's buying property A in Florida or buying property B in New Jersey, which is different, or using, even worse, using investor money to pay your personal expenses, which is a major issue. Case we're looking at is SEC versus Barton, Fu, and Wall. There's a number of different issues I'm going to run through, but let me just show you real quick, and then we can take a look at the actual case. All right, so this is in September 2022. U.S. Attorney has charged Timothy Barton, with wire fraud and securities fraud, alleging that $26 million was essentially taken from investors and they were defrauded, is what the allegation is. It's a criminal indictment and allegation. Obviously, they're presumed innocent until proven guilty. Also, the SEC filed a civil action against Mr. Barton and Mr. Wall and Mr. Fu. And here's a notice of that. I will also show you the complaint, and we'll just run through it real quick to show you some of the issues that come up and how they came up in this case. Here's the case that was filed in September. The allegation is that the three, Barton, Fu, and Wall, created a bunch of different LLCs, Wall 7, Wall 9, Wall 10, Carnegie Development, and that these basically Wall entities would go out and obtain investor funds as a loan that they were going to pay back. So let's see, get back down here. They call them agency and loan agreements. They're issued by each Wall entity, like Wall 7 wanted an agency and loan to buy property A, and it needed $2 million. And so it would issue loans to investors for $2 million. They were supposed to be paid back in 2 years, plus interest, to get progress reports. It was basically said that they were going to buy a specific piece of land with that loan. And there was also some collateral and a guarantee involved, which I'll go over. Now, the allegation is that after the money came in, which down here is a table of the money that came in 2017 to 2019, about $26 million from 100 investors, mostly Chinese nationals, that was not used as disclosed. The SEC is pretty clear, even though it says it's a loan agreement, this is a security, and case law, everything else backs that up. It's whether it's an investment contract or a note or just a straight loan, those are usually going to end up being securities. And so that's what they're alleging, that it was a security. The allegations are misappropriation of investor funds by saying, here's an example, Walls 12 loan agreement said, we're going to use your money to buy this 172 acres in Fort Worth. Allegedly, that Wall 12 never purchased that property. It might have been purchased by a different LLC, but these investors invested in this LLC, and it did not purchase that specific property. They're also saying that the purchase price and the funds raised were not used as indicated. What they are used for, they allege, is they were commingled amongst all the different investors and used for, allegedly, for personal expenses, unauthorized commissions and fees, Ponzi payments, they call them, prior investors in 2017. They don't detail this, but that's kind of what they mean, is investors in 2017 wanted their money back within 2 years under the loan. Investors in 2019, their money may have been used to pay back the 2017 investors, which is considered kind of a Ponzi type payment. And buying properties that were not listed in their offering materials. So they're saying only 2.6 of the 26 million was used for actual property, versus what they're claiming is these other unauthorized amounts are not disclosed. And the purchase prices they're alleging were inflated to raise more capital. So as an example, W9 was trying to raise 2.3 million. It said that it was buying a certain property for 2.9, and they were going to put in the difference. If they raised 2.3, they were going to put in the other 680,000 or 580,000, whatever it is, to buy the property. And allegedly they never did. And the actual purchase price of the property was not 2.9. They were inflating the price and not putting their own money in. And allegedly this is to raise more capital. And here's a table of what they say the represented purchase price was versus the actual. So 3.4 million versus the actual price only 1.5. And the Wall entities never put any of the money they said they were going to put in. There's also a guarantee backing up the loan saying that JMJ Holdings would collateralize or secure the loan with a guarantee. Basically, it was found out later that that LLC has no assets, has no income, no way of basically covering that guarantee. It's basically an empty LLC. So it's kind of a sham guarantee is what the SEC is saying. and it was not disclosed to the investors that it had no assets. The presentations also talked about these same type of issues, and there was quarterly reports sent out supposedly to clients saying, or to investors saying, no, everything's fine, everything's on track, we're doing good, when in fact some of the entities had not bought the property they were supposed to, and they didn't disclose where the money was used, and it says that didn't disclose that had already misappropriated investor funds. That's not really something someone would normally put in a quarterly report, but they're saying there was not accurate disclosure, and it was lulling to get the investors to think everything was fine when they're claiming it wasn't. Mr. Fu did receive about 14% of the total capital raise, or about almost $4 million, allegedly as a commission and success fee. Normally that's okay if someone's a registered broker-dealer and it's disclosed. He is not a registered broker-dealer with the SEC, and he is not entitled to collect a commission based on the capital raised. Neither is a lot of people who try to claim finder's fees. So they're saying that was wrong. And let's see, that he was an unregistered broker. So basically they're just alleging the different claims are under 10B and 10B5 for basically defrauding investors or misleading investors. 10B5, section 617, which is also sort of a similar misleading investors, and then also a separate allegation under section 15, acting as an unregistered broker. So we'll see where this goes, but this just gives you kind of an idea of some of the main areas that come up. And so as an example, here is some of the areas that I had talked about. Deception in your offering. Claim, the allegation is the use of proceeds, what the actual purchase price was, and the validity of the guarantee was not really disclosed properly. They were trying to use a loan to avoid registration as a security or an exemption when it actually was a security. That they didn't properly use investor funds as misappropriation. They didn't return the capital within 2 years like they said they would. The sponsorship team did not put their percentage they said they would put in, and the quarterly updates were not accurate or were misleading. So this basically goes back to some of the main areas that about disclosure, compliance, fee disclosure, executing on your business plan and information, and avoiding misappropriation. So just some general ideas of areas to watch out for, and make sure that you're properly disclosing everything in your offering materials, and that you have quality counsel that's helping you, securities attorney that knows and understands what the SEC looks for, what the rules say. So thanks for watching, and another episode of What Not to Do when raising capital.